My name is Steve Vickers. I'm a partner at Hart Shaw Chartered Accountants, and I'm going to be talking about business and share valuations. Any business owner will obviously need to know the value of their business if they're looking to exit the business and sell to somebody else. However, there are many other circumstances when a business or company value would be useful to obtain. We recently valued a business for some clients who were looking to raise £200,000 from venture capitalists. Without having that valuation carried out, they would have had no idea how much of their business they needed to give away in order to secure those funds. Anyone who's seen Dragon's Den will understand the point I'm making. It's very common in family and SME companies for shares to be passed to the next generation or to be gifted for tax planning reasons. However, many people are not aware that if they give shares away, they are actually taxed as though they had received market value for those shares, even though they've actually received nothing. To prevent surprise or unwanted tax charges, it is often a useful exercise to value the portion of the business being given away. An example of this was when we recently advised a family who owned a substantial property portfolio via a limited company. They wanted to pass shares on to the next generation, and in order to achieve this, we used a combination of outright gifts to the next generation and some of the shares passed into a trust. Valuing those shares was the first vital step in the process, without which the tax implications could not have been quantified and planned for. Business and share valuations are also often required for inheritance tax purposes, without which the executors of the estate could not finalise the estate's affairs. Similarly, valuations are often needed for matrimonial purposes. In a divorce settlement, the working spouse's business interests need to be valued before matters can be finalised. There are many other reasons why a business or a company may need to be valued. For example, in these times of recession, more and more of our SME clients are rewarding employees by granting them a stake in the business. This may take the form of a small award of shares or share options in the business. In my view, this is a good way of attracting and retaining key employees, because unlike a pay rise, an award of shares is a one-off cost for the company. We regularly implement share and share option schemes for clients. One example is the tax-favoured Enterprise Management Incentive Scheme. It's a bit of a mouthful, but basically it's a tax-favoured share option scheme for employees. Under this scheme, typically, employees are given the right to buy shares in the future at today's value, in the hope that the shares have risen in value in between. If this is done outside of a share option scheme, because they're getting something for nothing, that is, they're getting shares at a discount, they would be taxed as a benefit in kind on that discount. However, under an approved scheme, they are not taxed on that discount. However, it's vital for the purposes of the planning that the value of the shares is known so that no tax problems arise. In circumstances where the company does not qualify for an approved scheme, shares can be granted under an unapproved share or share option scheme. The term unapproved doesn't mean that HMRC have a problem with those schemes, it just means that they don't come with the tax breaks that the approved schemes do. So far we've looked at why you may want your business valued and how you might go about that process. Is there anything else we need to consider? When initially seeking to have your business valued, think about the depth of the work that will be involved in that valuation process. There are some valuers in the marketplace who profess to be able to value a business simply by looking at 2 years' historical financial statements. My real worry is that by doing that, they will not arrive at a true value of the business concerned. If I'm buying your business, I'm buying the future. Generally, we only use historical data because typically in SME and family companies, they do not produce forecasts. So we use that historical data as the starting point to try and get to the maintainable earnings that we think the business will be able to generate going forward. Without assessing these qualitative factors, in my view, there is no way we can arrive at a true valuation for any company or business. Any valuation based on historic data alone will inevitably be almost useless. An example of the pitfalls of getting the valuation wrong is if you're selling your business. If the valuation is too low, then naturally you're not going to receive its true worth when you sell it. If the valuation is too high, then by having your expectations falsely raised, this could delay the sale process by many months because the market just isn't prepared to pay what you think the business is worth. The valuation of any unquoted business or company is an opinion. And in particular, in a sale, a business will be worth what a buyer is prepared to pay for it. But by having a robust, in-depth valuation exercise carried out, you can be sure that the figure arrived at will be a sensible one. If anyone would like to know more about how a business is valued, then there is a dedicated section on our website, or if they'd like to speak to me, they can give me a call.